anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint Live. We are watching Trend Spotting. I'm Shraddha Babla. Good morning, Agam.
Good morning, Shraddha. I'm Agam Vakil, and in the next 30 minutes, we deep dive into specific trends in the markets and draw out key takeaways and their implications for investors. But first, the headlines. Benchmark indices trade with cuts. Nifty movers hovers around 10,300, and PSU banks away. Drug makers extend support. And Sobha jumps as much as 11% in trade after reporting the best sales numbers in the March quarter over a period of 12 quarters. And oil exploration and production companies gain as crude slips further. US President Donald Trump orders his administration to consider additional tariff on Chinese goods worth $100 billion, despite maintaining that the two nations share a very good relationship.
Let's take a quick look at how markets are faring at this hour. Indian markets, of course, seeing a consolidation after the big move that we saw yesterday. The Sensex seeing minor cuts of about 0.1%. In fact, much lower now. In the Nifty, hovering around the 10,300 mark. Pharma and real estate are showing some strength, but otherwise, all sectoral indices are trading with the negative bias. Financials also seeing a sell-off, as analysts don't see further upside in bond prices from current levels. So the bond price fall impact has, the bond yield impact, fall impact has probably played out yesterday itself. Advanced decline ratio equally distributed amongst gainers and losers in the broader market. But Agam, what are you watching out for?
Well, I'm actually tracking some gains in pharmaceutical companies such as Lupin as well as Strides Shasun, and I'm actually looking at a substantial increase in open interest for both these counters, which are extremely active in the futures and options space. And of course, as we've pointed out many times in the past as well, there's been some traction in the mid-cap IT companies, but I think I'd ask you to take over in that case, Shraddha.
Two things that I wanted to talk about, Agam. One, of course, the mid-cap IT names. All of those stocks doing well today. Emphasis was trading about 7% higher the last time I checked. Emphasis we're talking about, then Mindtree, Hexaware Tech, NIIT Tech, all of them were trading more than 3% higher. So all the mid-cap names are doing well. This is also, remember, the space which has demonstrated outperformance in 2018 so far, and Q4 earnings will probably determine if this up move will continue, and we will talk more about the expectations from some of these IT companies in the fourth quarter with Harit, Shah of Reliance Securities later on this show. So mid-cap IT is one area that we wanted to spot or point out. That apart, you also have IFB Agro. If we can pull that up, that has seen consecutive 2 or 3 upper circuits, followed by a 17% rise in the share prices today. I don't know if it's the impact of GM Breweries fourth quarter numbers which came out, because GM Breweries itself has not really reacted. If at all, it had corrected a bit. But as far as IFB Agro is concerned, I think there's also some ratings action at play there. But it's not just IFB Agro, it's the entire liquor and alcohol pack which is doing well, because if you look at stocks like Pioneer Distilleries, that was trading with gains of as much as 13-14%. You have Global Spirits, Pincon Spirits, those were also trading as much as 8 to 10% higher. So the entire liquor pack is moving, Agam.
Well, there you have it, guys. That's what's actually moving the needle in the markets as well. But moving on to see what we have on Trend Spotting today. First, of course, we discuss the key factors behind Sobha's strong quarterly sales performances, of course, with Director C Sharma, and what to expect from the information technology sector in the fourth quarter. We get an analyst view with Harit, Shah of Reliance Securities. And Indigo aborts its plans to bid for Air India under the government's current divestment structure. We cover all of that in the next 30 minutes, so watch out for that.
All right, so let's go on and talk about Showbar Limited, which is trading with strong gains of over 8% in the current trading session after reporting the highest sales in the last 12 quarters. What have been the key factors at play? Let's ask the management, who's joining us on the phone line, the Managing Director, C Sharma. Good morning, sir, and thank you very much for joining us. You've reported the best sales for the company in terms of, in value terms for FY18 at least. Just wanted to understand where this significant growth has come from in this quarter, because I believe the Mangalore and the Cochin markets witnessed a strong growth, but has it been more of a mixed bag as far as other cities are concerned?
See, Bangalore has been always one of our most stable and good market. We have delivered in the last quarter 750,000 square feet of new sales. At the same time, overall, we have done more than 1 million square feet of new sales, where primarily the contribution has come from Cochin and Gurgaon market. So what we are seeing is that even going forward also, because of this kind of the products and projects we have in these three markets, we should continue to get the traction from these markets. At the same time, with some new launches in Chennai as well as in other cities also, we hope to do better. And prima facie, our Bangalore contribution overall, which currently stands at 74%, it should come down, and still overall in volume terms and value terms, the sales should go up.
Okay, sir, so there were 2 project launches in the third quarter, 2 project launches in the fourth quarter. What's lined up ahead in terms of new projects?
Yes, we did 2 launches in the last quarter, you are right.
So what is the trend going ahead? What are the plans for FY19, the kind of and the quantum of projects and new square feet that you intend to build?
You see, we have planned launches in almost all the markets where currently we are operating. We are planning to launch projects in Chennai as well as in Cochin, as well as in Bangalore, as well as in Mysore, as well as in Pune, and if the required approvals and other things are put in place by this financial year, third quarter or fourth quarter, in Gurgaon also. So there will be new product and project launches all around. We remain confident that with the new launches and the market now bottoming out, post-RERA, post-GST sort of a thing, the sales volumes should continue to do better.
Right. Sir, so fair to assume you'll be launching about 8 or 10 projects in FY19 if that's something that you all have planned already?
Yes. We hope to do more than 8 to 10 new launches in this financial year.
Okay. And so what are the kind of net realizations you think you'll make on these new launches as compared to your average realizations for FY18?
See, we will be launching products across all categories. We believe that the current realization, about 8,000 rupees, inclusive of that of my joint development partners, we will be around that number. Sometimes a particular category product can be sold or will be sold a little bit higher, but it will not mean that there has been a price correction. But more or less around 8,000 rupees per square feet stable pricing, we hope to achieve in this financial year as well.
All right, sir. So I just wanted an idea about how your debt structure currently stands, and if we're expecting any big changes over the next year or so.
Come again, I could not hear your question.
I wanted to get a better idea of your debt structure, where it stands, and if there is any big changes expected changes over the next year or so.
No, as far as our debt structure is concerned, with the kind of operations and the volumes on the ongoing projects we are achieving, the construction costs we are incurring, the kind of land bank we have, our debt equity ratio and the absolute debt, both vis-a-vis the companies in our sector, it remains the lowest. And going forward also, we hope that we will sustain this kind of a debt equity ratio, which is around 0.8. The debt cost also continues to keep coming down. We have shown again reduction in this quarter as well. So we believe that on the debt front, we have got nothing to worry about.
So you've seen a 7.5% drop in the average price realizations in the fourth quarter. Is that in any ways indicative or suggestive of lower property prices? If you could just throw some color on what's happening with respect to the pricing trends in your key markets of Bangalore, Cochin and NCR, and how do you see them moving in FY19?
See, we believe that as far as the overall realization is concerned, as I was talking, we should not be reducing the prices. Prices have bottomed out. As far as, again, the increase is also concerned, we believe that looking at the overall market sentiments, it is not the right time to think about increasing the prices as well. So we will be cautious and we'll try to ensure that, yes, our margins remain intact. And overall, we should be cautious about increasing the prices on our products.
So that's as far as Sobha is concerned, but with respect to your industry peers, what has been the pricing trend in these three key markets?
See, as far as the industry is concerned, I think the prices in Bangalore market should continue to remain stable. The guys who have got their own balance sheet challenges or they are not in a position to sell for whatever may be the reasons, at an individual project level, they will be doing the transactions which may not reflect the current market situation.
So, and just the last question before we can let you go. So what is your target that you have in mind for FY19 in terms of volume and value growth? If that's something that
we believe that we can grow even in this financial year also on a double-digit basis. We are not giving guidance as far as the value and volume is concerned.
Okay, so thanks for joining us and giving us those details. Of course, that's Sobha there. It's a stock, of course, is doing very well on account of the kind of performance we've seen in terms of its volumes for the quarter gone by. And we will be watching out for other real estate companies as well and whether or not they also show that robust growth that Sobha has seen. But moving on, the earnings season has begun and we are connecting with analysts to discuss markets' key expectations from each sector. And today we focus on the information technology space, and technology stocks, especially from the mid-cap area, have certainly done very well in terms of the way the appreciation in the share prices. To get a better understanding and an idea of what's going on in the sector as a whole, we have research analyst Harit Shah at Reliance Securities joining us. Harit, good morning and thanks for joining us. Let me just start off with the large caps first, because those are the stocks that start announcing the numbers next week. What's your expectations from something like an Infosys or a TCS, or for that matter even Wipro and HCL Technologies? Are you expecting a steady quarter? Are there any concerns with respect to these giants?
Yeah, good morning. I think this quarter you should see relatively decent US dollar revenue growth. We've seen cross currencies move in a quite a favorable band for the IT companies. So the dollar has depreciated against the pound, euro and Australian dollar. So that will help the reported US dollar numbers by about at least 100-120 basis points. So from an overall perspective, about 2 to 4% or maybe 2 to 3.5% is our expectation as far as US dollar revenue growth is concerned for the top 4, top 5 IT firms. So I think among these companies we should see probably Tech Mahindra do relatively better off than the others. I think they are seeing some decent traction in the non-telecom space, and telecom also to some extent seems to have bottomed out. As far as Infosys is concerned, naturally so I think more than the results itself, the focus will have to be on the outlook and the new CEO's strategy to grow the company, and as to what is he planning to do with the earlier strategy which was inculcated by Dr. Sikka. So that is something which we would watch for very closely. And obviously the trends in the key BFSI vertical, how is that likely to shape up, given that it is the largest vertical for most of the IT firms, especially Infosys and TCS. I think that is another very important metric to look out for this quarter.
Hi Harit, good morning. What about the margin picture? Do you see any cross-currency tailwinds, or are margins more likely to be range-bound as per your estimates?
Yeah, so I think this time around you should see some stable to improving margins. Again, as you said about the cross-currency tailwind, and in fact, if you see the rupee movement, it has slightly appreciated against the dollar, but conversely, it has depreciated, against the pound and the euro. So on that, all billings in those currencies, you should see some positive impact on the margins. So on an average, maybe 50 to 100 bips is the kind of broad range we can expect, to see margins getting, margin expansion. Having said that, I think clearly going forward, given the importance of growing the digital side of the business, it is very critical then for IT companies to reinvest any kind of margin gains back into the business. So that is something which, again, another factor which I think we would watch out for.
Harit, I think the most important factor in terms of outlook is going to be the guidance, especially for guys like Infosys and HCL Technologies, because they give those numbers out, and for Wipro for that matter, because they give out the quarterly guidance. Are there any numbers that you are working with, any projections that you feel based on the kind of deals that we've seen so far?
So I think probably we could expect some sort of guidance which would, from Infi HCL Tech, maybe anywhere between 8 to 12% is what, a broader range is what we are expecting. Maybe Infosys would maybe like to be conservative initially, given the volatile economic environment, and maybe with they would like to leave the possibility of an outperformance maybe in the second half of the year. So that is something which they have done in the past, and I think that they may do that this time around as well. And similarly for HCL Tech also, maybe 8 to 10%. We are expecting actually somewhere closer to double-digit revenue growth. So that is something which is important right now, given the difficult global context that we are operating in at the moment. Wipro has, of course, been an underperformer in the last few quarters. They had some issues, client-specific and even vertical-specific issues. A positive thing now is that the oil and gas vertical seems to, I think, to have more or less stabilized, with oil prices back on at a relatively higher level. So hopefully that should sort of lead to some kind of an improvement in the oil and gas energy utilities vertical, which accounts for a higher share of their revenue compared to the other companies that they compete against. So Wipro, maybe the first quarter again tends to be a relatively slower quarter for the company. So they may not. I don't think you should expect too much by way of guidance, but typically second quarter tends to be a little stronger in terms of acceleration in revenue growth. So we probably have to wait one more quarter before we are able to judge as far as Wipro is concerned as to whether there's any kind of acceleration that we can expect.
Harit, is there any sort of a pricing or cost pressure that you foresee in existing or new deals?
See, as far as pricing is concerned, I think clearly for existing the commoditized services like ADM and maintenance, that is going to come down. It has been coming down for the last many years now, and especially given how severe clients are able to squeeze IT firms on this aspect. And so I think that is to some extent maybe offset by digital, in the digital deals, pricing is more or less quite okay. I don't think there's any major issue on that front. And now I think with digital revenues coming up to 25 to 30% of the total, I think now you should see that digital revenue drive and pull its weight. So that should hopefully offset any kind of pricing pressure that we see, especially in commoditized services. So overall we are expecting maybe flattish to maybe slightly softer pricing over the next maybe 1 or 2 years. Maybe half a percent to maybe 1 percentage point is what we can factor in lower pricing annually for the next couple of years.
With respect to the mid-cap IT companies, what we've seen is at least the share prices of these companies have moved up quite substantially in the past 3 months. And this was largely on expectations that they will do well. Of course, later on, in the middle of the quarter, we've had updates from companies like Persistent Systems, where they say that, at least one of their areas may show subdued growth and flat decline. Can we expect such negative surprises? And the reason why I'm bringing this up is because of the fact that we've seen such sharp appreciation in companies like Hexaware, NIT Technologies, even Persistent to a certain extent, and many other mid-cap IT companies. What are your expectations here?
Yeah, I think on the mid cap side, very clearly, you are going to get this kind of divergence in performance. That has been the case historically also. So when they, given that typically mid cap companies are focused on specifically one or two verticals, you will see them do better than the top tier firms when those verticals start to do well. And obviously, conversely, when if they have any specific client issues, then you will see them do a lot worse. So, see, Persistent, I think, was a one-off. I don't think this is something that can be attributed to the sector as a whole. This is very much a company-specific issue, and they've also clarified that FY19 will be a better year for them. I think they should do better off than much better than what NASSCOM has guided for. So I wouldn't worry too much about that. But on the mid cap side, again, yes, this quarter I'm expecting them to do a little better than most of than the large caps. Especially I think companies like Cint and Mindtree, we are expecting better growth, and Cint itself has guided also for about indirectly for about 7-8% kind of 6 to 7% US dollar revenue growth. So they should do pretty okay in this quarter. Stock prices, unfortunately, of course, are fairly rich. I mean, they're quite richly valued now. Hexaware is coming close to 19 to 20 times CY19 earnings. Mindtree is close to 18 times FY20. So from that perspective, there's very little room for any negative surprises, is what I would say. So therefore, I would be a little cautious as far as picking up mid caps at these prices are concerned. So within mid caps, Cint is one company which we like, and even Persistent now after the correction and after factoring in a poor fourth quarter and subsequent impact on FY18-19, it is still trading at least 25 to 30% discount to a company to stocks like Mindtree and Hexaware. So this is what we would prefer on the mid cap side.
All right, Harit, thank you very much for joining us here on Bloomberg Quint. A slightly better margin picture is what we're likely to see for IT companies in the fourth quarter, and that's the word coming in from Harit Shah of Reliance Securities. But with that, let's shift focus to an interesting development in the aviation space and Air India divestment. Now, Indigo shares, Interglobe Aviation, that is, shares had dipped about 2% in opening trade after stating that it's not interested in Air India anymore, at least not under the proposed divestment plan. Now, the airline, which was one of the first companies to show keenness in acquiring the national carrier, is also one of the first to pull out. Amit Sarkar is standing by with more. So Amit, to be fair to Indigo, they have always maintained that they're only interested in the international operations and Air India Express.
Yes, Indigo said the first intention back in July 2017, and since then they have repeatedly said that they are only interested in Air India's international operations and Air India Express. But the current proposed divestment plan by the government says that you will get 76% in Air India, which will also have the domestic operations of Air India and a 50% stake in the ground handling unit. So what Indigo is saying that they cannot turn around the whole Air India, and they're only interested in Air India's international and Air India Express. So that is the one reason why they are opting out. And the secondly and most important reason that I think they are opting out is because government will continue to hold 24% stake in Air India. Now, Indigo had clearly said that they are not interested in any kind of joint venture with government. They also went on to say that they don't want a minority stake, that they also don't want government to hold a minority stake in the company. So this could be the other trigger that would have made them to opt out from this Air India bid. So these are the two possible reasons why Indigo has opted out from this bid.
Meanwhile, Indigo is also dealing with its own set of engine troubles right now, but that doesn't seem to be reflecting on its stock price. So what's going on there, Sumit?
So if you see the stock price performance for all the three listed airline companies for 2018, you can clearly see the outperformance. Now, Indigo has gained close to 20% in 2018, while Jet Airways has gained close to, is down around 25-26 odd percent, and SpiceJet is down close to 8%. Now, this outperformance has come in from Indigo despite various concerns like depreciation in rupee, rise in fuel prices, grounding of aircrafts, which led to cancellation of more than 900 flights. Because of these concerns, yet Indigo has outperformed. So let's see what could be the possible reasons why Indigo has outperformed. Now, if you see the passenger growth of all the three listed airline companies, Indigo has outperformed SpiceJet and Jet Airways in the first 2 months of 2018, that is Jan and in Feb. In the month of Feb, Indigo's passenger growth was 26%, while that of Jet Airways and SpiceJet was 14% and 18%. Now this has come after a subdued second half of calendar year 2017. So this could be one of the things that is working positively in the minds of investor. Now these numbers do not reflect the impact of cancelled flights that happened in March, but the impact of that is anyways expected to be limited because its nearest competitors, that is the Jet Group and SpiceJet, are running at a very high capacity utilization. The passenger load factor for SpiceJet is 26%, while for the Jet Group is about 90%. Now if you see for the month of Feb, among the top 8 airline companies, 6 of them are having a high passenger load factor. So because of this capacity constraint, the impact of passenger growth and market share loss on Indigo will be limited, and that's one positive thing for the company. And on the financial side, if you see, there won't be any impact because they have said that, and in the past also they have been reimbursed by the engine maker, that is Pratt & Whitney, for any financial loss that they had because of this engine issues.
All right, but Soumitra also looks quite confident of sustaining this kind of passenger growth. That is, if you go by the number of aircrafts that they've been buying.
So if you see in the last 1 year, the air traffic growth was on an average around 17%, and Indigo has supported this passenger growth by adding more aircrafts. Now they have added close to 27 aircrafts in that period, while Jet Group has added only 3 and SpiceJet has added close to 11 aircrafts. Now going forward, multiple brokerage reports are expecting the air traffic growth to grow annually in the range of 15 to 20% over the next 3 to 5 years. And to support this growth, all the 3 airline companies are inducting more aircrafts, but in that too, Indigo is leading. Indigo has planned to add close to 445 aircrafts, while Jet Airways, the Jet Group combined, has planned to add around 150, while SpiceJet will be adding 200. So in that case, also Indigo is leading. Now on the cost side, if you see, yes, higher fuel prices and weaker rupee will have some impact on the cost side, but if you see the cost per available seat kilometer for Indigo, it is the lowest. It is at a 13% discount to its nearest peer, that is SpiceJet. Now SpiceJet's cost per available seat kilometer is 3.8, while that for Indigo is 3.3. So this gives Indigo a higher margin to bear this impact in a cost competitive market. Now this cost can further go down by around 15% because of the fuel efficient aircrafts that these guys are inducting. Now analysts also believe that the higher fuel prices are not directly impacting the airline companies because they are passing on the hike. So whatever the case might be, they are passing on the hike or they are not passing on the hike, Indigo is still safer when compared to SpiceJet and Jet Airways on the cost side.
All right, Soumitra, thank you very much for that elaborate analysis that you have done. The shares, of course, of Interglobe Aviation are trading with marginal gains. It opened lower, but they're trading with gains of about 0.4%. There's also a mixed view coming in from brokerages because Motilal Oswal report earlier today said that they believe that Indigo deciding to not bid for Air India was a wise thing to do, and they said that this was a positive move for the company. SBI Cap Securities, on the other hand, they've said that Air India would have actually been a great buy for Indigo, and the stock they expected would give up gains as Indigo or as Air India would have come at a lucrative price. So let's see how that story unfolds for Indigo and Air India as well. But with that, it's a wrap on this edition of Trend Spotting. Up next is Hot Money. Stay tuned to Bloomberg Quint Live.